so we dropped everything. We're remaking a video on how banks create money because so many people have been asking us about it. First off, let's look at the basics. There are 3 ways that money is created. 1. Physical money. 2. Money created by private banks. Governments create physical money, which they then give to their central banks. Here in the US, we call our central bank the Fed, or the Federal Reserve. The Fed then distributes the physical cash to the commercial banks throughout the country. Quantitative easing, also known as QE, is when the central bank, the Fed here in the US, creates new money out of thin air and uses it to buy assets, mostly government bonds. When the Fed does this, it puts more money into the economy. The European Central Bank and the Bank of Japan have been doing it too, and it's having a similar effect on their economies. After the 2008 financial crisis, national debt in the G7 countries went up by about 30%. It's no longer something that they only use in times of crisis. Well, that's impossible to say for sure, but some economists think that it will happen eventually. When it does, it could cause some serious problems. Here's why. First, the Fed's balance sheet is gigantic. It owns about $9 trillion worth of bonds. If you want to learn more about the dollar meltdown theory, check out our video on that too. We're just 2 guys making videos in a garage. And we've learned that the best way to make money is usually not through investing in individual stocks or cryptocurrencies, but rather through buying index funds or ETFs that track a broad market index. That way you get exposure to all kinds of different companies, and you don't have to worry about picking individual winners. We're not financial advisors. You should always do your own research and due diligence. If you want to learn more about how to invest in index funds and ETFs, check out our video on that too. If it sells those bonds, it will take a lot of money out of the economy. That could cause a recession. Second, higher interest rates could cause a wave of defaults. A lot of companies and countries have taken on a lot of debt in recent years, and much of that debt is at very low interest rates. If interest rates go up, those companies and countries will have to spend more money on interest payments, and that could cause some of them to default on their debt. Third, the dollar could strengthen. When interest rates go up in the United States, the dollar gets stronger. It could hurt U.S. exports, make it harder for the U.S. to compete with other countries. And finally, stock and bond markets could crash. When interest rates go up, bonds become less attractive as an investment, and stocks become more expensive. That could lead to a crash in both markets. The Fed has been buying bonds for over a decade now, and they do and seem to want to stop. Cryptocurrencies could be another option, although it's worth noting that cryptocurrencies are still relatively new and their long-term value is unknown. Well, it's hard to stop because once you start doing it, it's really hard to undo. Some people think that we're headed toward a dollar meltdown. Others think that we're headed toward modern monetary theory. Whatever happens, it's clear that the current financial system is creating huge amounts of wealth for a select few while leaving the majority of people behind. The richest people in the world have benefited enormously from the creation of new money and asset inflation. Meanwhile, the poor have struggled to deal with the consequences of inflation and job insecurity. If the Fed wants to stop buying bonds, it will have to sell the bonds that it already owns. And that could lead to a recession. So the Fed is kind of stuck. After the COVID-19 pandemic, it went up by another 40%. And guess what? It's still going up. This can help the economy grow, but it can also cause asset inflation. It's also helped to keep interest rates low, which has made it cheaper to borrow money. But it's not without its risks. One risk is that it can lead to asset bubbles. When the Fed buys government bonds, it drives up the price of those bonds, and that can make other assets look like a good investment. For example, when the Fed was buying mortgage-backed securities in 2009, it drove up the price of houses. Some people think that this contributed to the housing bubble that eventually burst in 2016. Another risk is that it can lead to inflation. When the Fed creates new money and puts it into the economy, it can cause prices to rise. And that's exactly what's happening right now. Inflation is at a 40-year high in the United States, and the Fed is still buying bonds. You see, when the Fed buys government bonds, it's essentially bidding up the price of those bonds. This pushes up the prices of other assets too, so people who already own assets tend to get richer when the Fed does this. But people who don't own assets, well, they're not benefiting from this asset inflation. Physical cash makes up only a tiny portion of the total amount of money out there, between 3 and 8%. For example, after the 2008 financial crisis and during the COVID-19 pandemic, the Fed was worried that the economy was slowing down, so it started buying government bonds. The Fed bought about $120 billion worth of bonds each month. This pumped money into the economy and helped the economy grow. The Fed was hoping that this would also lead to job growth and wage growth, but unfortunately, that hasn't happened. Wages haven't kept up with inflation in the US since the 1970s. The rest of the money, about 97% in developed economies, exists only in digital form, as numbers on computer screens. And 3. Quantitative easing, aka printing money. Basically, the value of each individual unit of currency goes down. Kind of like playing a video game, like a virtual football player. If the game developers print too many football players, the value of your football player goes down. His stats may be the same, but if there are way more football players in the game, he becomes relatively less valuable. In real life, if a government prints too much money, each unit of that currency becomes less valuable. For example, if the US government printed $10 trillion worth of new bills, the price of everything would skyrocket. Houses would cost millions of dollars, and a Big Mac would set you back 10 grand. That's exactly what happened in Zimbabwe. Their currency became completely worthless. They had to carry around wheelbarrows of cash for basic goods and services. Let's start with physical money, cash. When a government prints too much physical money, we get what's called inflation. So yeah, it's important that we keep the supply of physical cash in check. Now let's talk about the other type of inflation, asset inflation. We'll get to the third type of money creation in just a second, but first we need to talk about asset inflation. When an asset like a house or a painting or a football player in a video game becomes more valuable over time. So let's say there's a limited supply of football players in a video game. If lots of people want to play with those football players, the demand for those players will go up, and their value will go up too. Owners of the football players will be pretty happy about this, because their players are now worth more. But the people who do, and own any players, and want to buy one, will be pretty sad because they'll have to pay a lot more money for a player than they would have had to before. Okay, now let's get back to the third type of money creation, quantitative easing. Now, why does the Fed do this? Well, the Fed uses QE when the economy is in trouble. The Fed isn't the only central bank that's been doing this. Now, QE isn't all bad. It's helped to prevent a depression, and maybe even a second Great Depression. In fact, quantitative easing has become a normal part of the central bank's toolbox. The big question is, will the Fed ever stop buying bonds? So yeah, if you have money, it's probably a good idea to diversify into things that aren't as susceptible to inflation like gold. As for how this all plays into the future of our society, well, that's anyone's guess. If you want to learn more about modern monetary theory, check out our video on it. Now, you might be thinking, well, if I'm not rich, how am I supposed to get rich? And to that we say, well, duh. And on that note, we've made a ton of videos on investing, day trading, cryptocurrency, and all kinds of other stuff. If you want to learn more about this, check out our video on passive income. Thanks for watching, and until next time, happy investing.